In audit, auditors deals with thousands, sometimes even millions of transactions. Now, practically speaking, auditor cannot verify every invoice, every journal entry, and every supporting document individually. So before performing detailed testing, auditor first try to understand one very important thing. Do the number actually make sense? And this is where analytical procedures under ISA 520 become extremely important. Analytical procedures help auditor identify unusual trends, detect possible risks, focuses on audit attention on high-risk areas, and determine where deeper substantive testing is required. In this video, we'll understand what analytical procedures are, how auditor perform them in real audit, how analytical review connects with substantive audit testing, and how auditor use analytical thinking to detect hidden misstatement using detailed practical examples. Core concept of analytical procedures. Analytical procedures basically mean evaluating financial information through analysis of relationships, trends, fluctuations, ratios, and comparisons. The auditor compares current year versus previous year, monthly and quarterly trends, budget versus actual performance, industry average, financial data with operational information, and expected relationship within the business. The purpose is simple. Identify movement that appear unusual, inconsistent, or unexpected. Because unusual fluctuation may indicate error, fraud, manipulation, missing accounting entries, incorrect accounting treatment, weak internal controls, or even management override. For example, sales increased significantly but cash collection didn't improve. Production increased but power expenses remained unchanged. Employee count increased but payroll expenses reduced. Profit increased sharply but operating cash flow became negative. Now, these relationships help auditor identify hidden audit risk that may not be visible through simple document testing. This is why analytical procedures are considered one of the most powerful risk assessment tool in auditing. Detailed practical example. Now let's understand the most common and most important analytical review area, revenue testing. Suppose a company had revenue of 50 crore last year and 80 crore this year. This means revenue increased by 60%. Now at first glance, management may simply say business performed extremely well this year, but auditor do not stop there. The auditor immediately start asking practical business questions. Step number 1, business understanding. The auditor asks, did production capacity increase? Did the company hire more sales staff? Were new customers added? Was any new branch opened? Was there a new product launched? Did market demand actually increases? Was there any major contract obtained during the year? Because under auditing standard, numbers should be aligned with the business reality. Step number 2, compare revenue with production. Now suppose production increased only by 10%, but sales increased by 60%. Now logically, this does not align properly. The auditor starts questioning, was old inventory sold aggressively? Were fictitious sales recorded? Were dispatches manipulated? Was revenue recognized before delivery? Were year-end journal entries passed manually to inflate sales? This mismatches become a potential audit risk. Step number 3, compare revenue with receivables. Now assume trade receivable last year was 8 crore, trade receivable this year is 25 crores. This becomes another major red flag. Why? Because if sales generally increased, collection should also improve reasonably. But here, sales increased sharply and revenue also increased abnormally. This may indicate fake customers, weak recoverability, circular transactions, related party routing, or revenue booked without actual collection capability. Now the auditor may also calculate receivable days. If debtor days suddenly increase from 45 days to 110 days, the risk becomes even higher. Step number 4, monthly trend analysis. Now the auditor perform month-wise sales analytics and imagine this finding. Out of the additional 30 crore increase, 18 crore sales were booked only in the last month of the financial year. Now this becomes a serious audit concern, especially if prior months were unstable and year-end sales suddenly spike abnormally. This could indicate cut-off manipulation, channel stuffing, fake dispatches, bill and hold arrangements, and round tripping. The auditor now focuses especially on transactions recorded in the final month of the year. Step number 5, linking analytical review with detailed testing. Now this is the most important practical audit concept. Analytical procedures themselves do not prove fraud or misstatement. They only identify unusual movements and risk indicators. After identifying the risk, the auditor performs substantive procedures. For example, number 1, invoice testing, checking whether the sales invoices are genuine and properly authorized. Number 2, dispatch verification, matching invoices with delivery challans, transporter documents, LR copies, e-way bills, and gateway outward register. Number 3, cutoff testing, checking whether sales recorded in the last month of the financial year actually relates to delivery made before year end. Number 4, customer confirmation, obtaining direct balance confirmation from the customers. Number 5, GST reconciliation, comparing revenue with the GST returns filed with the authorities. Number 6, journal entry testing, reviewing unusual manual sales entries past new year end. Number 7, credit note review, checking whether sales booked in the final month of the year were subsequently reversed after year-end credit notes. Now, this becomes a complete audit flows. Analytical review identifies the risk, detailed substantive testing verifies whether misstatement actually exists, and this is exactly how analytical procedures work in the real-life audits. Detailed practical example, gross profit margin analysis. Now let's understand another extremely important area, gross profit margin analysis. Suppose last year gross profit margin was 38% and this year it reduced to 20%. Now this is a major fluctuation. The auditor immediately investigates the reason by following the below steps. Step number 1, understanding management explanation. Management may explain the reason for reduction in gross profit margin is due to raw material price increase, competition force price reductions, market slowdown affects margins, foreign exchange losses impacting costing, or product mix changed. But under ISA 520, the auditor cannot simply accept the explanation verbally. Every explanation must be supported with audit evidences. Step number 2, corroborate the explanation. Now the auditor performs additional analysis. Number 1, purchase trend analysis, by checking whether raw material prices genuinely increased. Number 2, cost sheet reviews, by analyzing manufacturing cost per unit. Number 3, inventory testing, by checking whether inventory valuation is accurate. Number 4, production analysis, by comparing input-output ratios and wastage level. Number 5, industry comparison, by comparing margins with competitors operating in the same sector. Number 6, standard cost versus actual cost comparisons, checking whether production inefficiencies increased. Step number 3, identifying hidden risks. Now imagine the auditor discovers raw material prices increased only by 5%, whereas the gross profit margin reduced by 18%. Now the management explanation becomes weak. The auditor may suspect inventory overstatement in prior years, unrecorded purchases, theft or wastage, incorrect costing, fake revenues, or manipulation of closing stock. Now, additional substantive procedures become necessary. This may include physical inventory count testing, purchase cutoff testing, cost recalculation, BOM verification, valuation testing, and product-wise margin analysis. Again, notice the audit logic. Analytical reviews identify abnormal fluctuation. Here, the auditor investigates by performing detailed audit procedures testing. Building auditor expectations. One of the most important concepts under ISA 520 is developing an independent expectation. The auditor independently estimates what a balance should approximately be and then compares the expectation with the actual recorded figures. For example, if a company has 500 employees and average monthly payroll is 40,000 per month, then the expected annual payroll should approximately be 500 multiplied by 40,000 multiplied by 12 months, so it comes to approximately 24 crores. Now suppose actual payroll recorded is only 16 crores. The auditor investigates, are salary expense understated? Were bonus provision omitted? Were contract employees excluded? Was payroll shifted to another ledger? Were year-end accruals missed? Final summary. So overall, analytical procedures are not just ratios calculation, they are a method of understanding business behavior, identifying unusual movements, linking financial data with operational reality, developing independent expectation, and directing audit attention towards high-risk areas. The complete practical audit flow is identifying fluctuations, investigating reasons, corroborating explanation, performing detailed testing, and conclusion. And this is why ISA 520 is considered one of the most practical, investigative, and powerful auditing standard in real audit engagement. Thank you for watching. Stay tuned for more audit content.